Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, March 28th, 2023. It is 9:58 a.m. Eastern Time, so I'm starting the video, so we're about a half hour into the trading day. I want to do a quick update, and I'll kind of, won't be a real long video, but I'll be all over the place. In other words, covering all the various, not all of them, but some of the different things that I'm watching right now that stand out to me. I'll start out as I usually do with the equity markets. This is that 60-minute chart of QQQ, no change in the tech, well, a little bit, that's why I'm doing the video, but a little bit of a change in the technicals, but no change in my outlook. What we have is the divergent high, negative divergence, divergence on both the PPO and RSI leading up to the recent high. That recent high was the called the post FOMC spike right there from last week's rate decision. And so what I did, I added a box here that shows the high of that and the low. That candle, we had the initial reaction, which as so often is, was faded. The initial reaction, the market rallied because he just did the expected quarter point. Then we got that breakdown, solid red candle that came on the last 60-minute candle of the day to close right on that 306.44 target down there after the breakdown. Went on to make a back test. If you missed the breakdown, you had an opportunity to short the back test. And here we are. So I boxed it in because I think that's probably a key psychological level of both the top and the bottom. So in other words, if the market can rally up, down through there, it's done a lot of things. It may or may not take out the divergence, but it could. Although the divergence will probably just be a little bigger, would be bigger, certainly, if it's a marginal new high and it happens soon. See, if you'd have to go up now. If it, flounders around for a while, we go into trading range, then who knows how these indicators are going to look. I don't bank on it. I've been pretty clear and adamant which way I think things are going to break, and still positioned that way, which is to the downside. But we need to take out, I think, that spike low following the breakdown, and that's where we're at. We're right now testing it. I had a minor trend line, possibly since the last update I gave you on this chart yesterday. There's a minor uptrend line that was taken out, gave us a sell signal, and then these are all the same levels I had given you before, 306.44. Again, which was already hit there. And the way my targets work, typically I expect a reaction off the initial tag of each one when they're downside targets, so the initial tag from above. And not that you can't continue to bounce on it, but it just increases the odds that you're going to take it out, whether you have another reaction or not, because it's already been hit. It's been checked, if you will. And so that opens a door for a move down to the next targets here. And like I said, I've been drawing arrows that show a much bigger drop. That's as of now what I'm leaning towards still. I know it's probability may be pretty low. It's calling for a pretty big move down. So we'll take it, day by day, tick by tick, see how the charts look, see how the market leading stocks look, see how all the sectors look, bonds. I'm going to get to that in a second here. I try to watch as many things as I can out there. So far so good, and just go through the market leading fangs. I still overweighted the tech sector. I was overweighted the tech sector off the lows in January, and expected them to outperform to the upside, and they did. And they just as of recently, after some consolidation, they started to correct in February. But as of recently, I saw one of the most insane things I've ever seen, and that was it appeared the market was treating big tech, the big fangs, Apple, Microsoft, Alphabet, Amazon, Facebook, as flight to safety trades during the banking crisis recently, or could be ongoing. We'll see. And to me, that's insane. And the other aspect too is, if nothing else, and I was pretty adamant about this, and I see no other way to spin it. Every single fundamental metric, even technicals, the problem with the banks only increase the odds of a recession, which were already pretty darn good with the inverted yield curve, everything else. But I think all experts agree it's going to, if nothing else, tighten. They might have, the Fed may have shored up the banks themselves, but it's certainly going to restrict or constrict lending standards, and there's no net positive for that. The economy, that's a form of tightening. And so Wow. So anyway, what I'm getting at, these are cyclical stocks here. You know, if you're going into recession, you might want to put money in utilities, defensive issues, Procter and Gamble, and the likes. But tech stocks are one of the most sensitive sectors to the business cycle. So again, logically, but then again, the market's never really been logical, has it? So, anywho, I always, I do factor that fundamental rant I just gave you into the technicals. But like I said, the technicals, the best shorting up I've seen in a long time on the big fangs. I already went through them all. Nothing's changed. I'll put in those divergent highs recently. I just want to mention that Apple, I was watching a key level right here. Boom, 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 breakout. And if it can stick this early session down, well, we did. We had a closing 60-minute candle blow at 157.63. That's a lot of big reaction highs there, and so that makes it's a little early. Like I always say, these things are incremental, not all or none. But it is a sell signal. Give it a check mark, obviously. As I like to say, the redder the better. So if we can get, sell signal or breakdown. So the farther you get away from there, the greater it's going to increase the odds that this whole thing was a bull trap, aka false breakout. What we do know factually, it was a divergent high. Factually, that 157.63 level just broke down, but we're still, in close proximity. And then you have this big level right here, this blue uptrend line. That's our primary uptrend line. Gives us a big bearish rising wedge here on the 60-minute chart of Apple. I've gone through all the others. They're, breaking down as well. Microsoft coming off a divergent high. Also, I'm on the 60-minute chart. Alphabet, boom, steep wedge, divergent high, just like you had right here. Same stuff. Just watch, rinse, repeat. That was a divergent. Actually, draw it out like that. There was your divergence right there on that final little marginal new. That's what I talked about, those marginal new highs when they're divergent highs. That's sometimes that little blow off type top you need. Either way, this one broke down and didn't look back. At support, I'll give it points for that. It should bounce here. If I was a bull on Google or Alphabet, this is where I'd step in and buy it. Probably get a bounce, but to me, most likely be a bounce that gets faded. And there was a little bear flagging in between there after the breakdown. So, yeah, you've got this one at support. I'll give it that. Apple just breaking support. Apple's more important, being the biggest one of the group. Amazon, I'm not going to go through them all. I'm working my way towards Tesla. I want to show you guys something I found last night. NVIDIA, you guys know my thoughts on semis, one of my favorite and most overweighted short sectors right now. I like it all the better because everyone else doesn't like it. Most people on the site. I like to be a lone wolf on trades, whether it's long trades after an extended downtrend. There's no believers that you'll get a reversal or extended trades on the upside. So nothing's changed there. Let's talk Tesla. I mentioned Tesla the other day as one of my a nice looking short, at least one of my favorites, I guess you'd say. And if you want to trade the individual stocks, remember, if you're trading QQQ or NQ, you're just shorting its concentrated portfolio of Apple, Microsoft, Alphabet, Amazon, Tesla, NVIDIA. But I mentioned this trend line right here as a short right there, and nothing big so far. It was around that $200 resistance, but the stock's down 6%, and you can see now it just took out this triangle pattern right there. Nice clean. So you had a almost symmetrical triangle pattern, but definitely a downtrend line. And boom, just like Apple, it just broke support. So check marks was all I'm trying to say for the bearish case. And of course, as I've been maintaining for 2-3 weeks now, we need to take out those highs from the reaction lows from back here, Monday the 13th of March, right there. That will kind of put the nail in the coffin for the bulls. Alrighty, what did I want to show you about Tesla? Okay, Tesla. Go back to Tesla. Just may or may not mean anything. There's the chart. Tesla, of course, this is a stock that topped. This is a stock in a bear market. Make no mistake about it. The rallies are powerful. It was one of my favorite in long positions off the lows in January, as I told you. We went up, rallied up, and even exceeded my uppermost target. We recently shorted it right here, covered, reversed, off that T2 level, so that was a nice trade that came after this breakdown right here, and it continues from that. That was that same, there it is, just was the first one, got ahead of itself, so it was the first one to top on the big fangs. Apple, I think, will join it in the others, so this is probably where we're going. Anywho, so Tesla. Okay, so you guys probably know what circadian rhythms are. Those are the our natural, or any living animal natural daily cycles. Humans, were diurnal, so our circadian rhythms, it's when we sleep. Let me grab what I'm trying to grab here for you. Elon Musk. All right, so I don't know why, it just my brain's always thinking about what's going on in the markets, and I haven't heard a peep in the headlines about Musk lately. And Musk, for the last few years, has been in the headlines a lot. And every time he opens his mouth, it's something big. The guy's brilliant, but he's an egomaniac. It would be an understatement to say that. So, he likes to see if he can move the markets, likes to do things, gets in trouble with the SEC. But, at the end of the day, again, whatever, and sometimes those troubles do carry over to Tesla. So I did this just for kicks and giggles here. I took a look at the Google Trends. Kind of cool. I've used this thing for years. You type in any search term and it shows you the rate of incidence of interest in those search terms. So I noticed a pattern right here. This is late March, just right about the end of March. There seems to be a trough in interest. Obviously that's because he's kind of gone, dark, not tweeting up a storm for whatever reason. And again, that's the end of March, and that's the end of March. And then there's an explosion in interest. So these are, I don't know, you guys can look back on the headlines, whether this was maybe the Twitter takeover right here, probably, I'm imagining, and everything else. So it's a pretty clear cycle. Now, doesn't go back forever, because Musk really was not, 10 years ago, nobody knew who he was. And so he's really, in recent years, with the huge growth in Tesla, become a thing. So take of it what you will. Something's about to happen, I suspect. These are his circannual rhythms, I think they call it. There's, the daily or circadian rhythms. You have monthly, semi-monthly. There's terms for all those, and then there's a term for an annual rhythm. And so, whatever reason, I don't know, around the end of March, beginning April, he starts something. And anyways, we'll see if that sometimes. And I looked at the stock, by the way. What happens? And there is always, or has been, since back there last couple of years, an inflection point. Back then, this was the end of March, early April, right here. Tesla had just corrected and then started a huge, powerful, one of the biggest uptrends in a while. Let me change my arrow color. So, and then this time around, again, another leg up. And this time around, I don't know if you can see when I say this time around, I have these little lines drawn right at the end of end of March, early April. That one started a pretty big downtrend. I don't know. So, we were in a bull market here, and so every time back then, there might have been an initial knee-jerk reaction, and then it was bullish. Lately, it's been going down. Either way, they're inflection points. There seems to be inflection points, turning points in the stock around then, whatever shenanigans Musk is pulling. So we'll see. I probably spent more time on that than I should have, because it's just an observation. We'll see if we start seeing Musk pop up in the headlines soon. And again, I'm kind of dovetailing it with my outlook for Tesla. So of course that can go either way. You break to the upside, that's hard to argue is anything but bullish, especially break over 200. That would really be, because we have a few reaction highs there, a reaction high there, big old gap, bunch of gaps there. 200 is a big level in Tesla. Bullish if taken out, bearish if we cannot take it out. Okay. Now let's just segue over to, or not segue, there's no segue, there's a completely different asset class. Let's shift over to commodities real quick. Think it's time for the next leg up in commodities, and I'll tell you why. I've maintained for a long time. There was someone tried to argue otherwise on the site. Well, how can you be bearish on the stock market and bullish on commodities? And the answer to my question was, historically, commodities and the stock market did move up and down together, and it makes sense, right? When the economic conditions are bullish, when you're in an economic expansion, there's a higher demand for commodities. You're building houses, airports and everything else. Well, those can be also funded during a recession with stimulus, but commercial property buildings, everything else. There's construction going on. There's a higher demand for gasoline. People are traveling more, taking vacations, so commodities tend to go up. However, that wasn't the case. The Fed has just completely, not completely, but to a very large extent, I've said this many times in the past, destroyed the natural mechanism of price discovery. The Fed has had such a heavy hand in the markets since 2008. So what happened in 2008, among other things, when they embarked on a zero interest rate policy, quantitative easing, refusing since then, it's been over 15 years, to allow any recessions to hit, no matter how healthy they are, how necessary recessions are for longer term economic growth so you don't create imbalances and things. Well, what happened is, and I've said this many times, but it bears repeating, we entered a bear market in commodities, and it was a vicious, and it was a long-term 13 plus year bear market that ended in around 13 years, ended in when COVID hit. At the bottom, when the stock market bottomed. So you had, up until that last leg drop off, you had stocks doing this. We all know what happened since 2008. And you had commodities doing this. So there has been for now over 15 years, a 100% clear and unmistakable inverse correlation. So that doesn't have to remain, but what I can say, and I've said many, many times, is that by every single metric that I use, including the primary bear market downtrend line in commodities right there, the big divergent low, DJP is my broad-based commodity ETF. We started, and we're clearly in I believe, a new early stage bull market by the technicals. So fundamentals, I talked about that disconnect. We're also in one of the hottest inflationary environments in nearly 5 decades. You can't argue that either, and that typically is bullish for commodities. They tend to go up in inflationary environments. And we also completed, as evidenced many times over, the biggest secular bear market in interest rates in history since 1981, when interest rates peaked in the early 80s, and they bottomed recently as well when COVID hit, and had no more downside to go. So by all metrics, we're looking at rising rates, everything else. I'm going to get to rates in a second. And then DJP, this is a big level to me right here, 3081-ish. This is a weekly chart. You have a key Fibonacci level there, the 38.2% retracement of the move off the bottom right here. We had this rally, which I have been maintaining emphatically since really even before it got going. It would be most likely, but then confirmed new bull market action, higher highs, higher lows. So from the lows in COVID to the recent highs, we just retrace exactly right there, the 38.2. That is a typical and really minimum counter trend, not hardcore minimum, but typically 38.2 to the 61.8 fib. This is your typical retracement zone in a primary trend, meaning nothing goes up forever. You have a move up and you correct, and you usually correct back to about a 38.2%, 38.2%, 50 or 61.8 retracement, and that would be just a minimum. And so it's great support. It's price support, as I've just showed you here. Major reaction lows, major reaction high, major reaction highs. And so that's me. I'm liking commodities. I know right now, and again, from the comments, most people, commodities in a bear market, Fed won, inflation's over. No. I don't think so. You can see a downtrend line here. Again, that's the weekly chart. You go to the daily chart. For a long time, I mentioned, I had these targets. I said, worst case scenario, I see us coming down to around that $31 level. That's that major reaction high right there. And we just hit it. We have positive divergence. So now, okay, I'll be right or wrong, but I do like commodities now. I think the risk reward is much better than the stock market. And if they start to rise, then what that's going to do is the market has completely dismissed Powell in the Fed. They're being dismissive of Powell, who's saying he's going to continue to raise rates and fight inflation, and the market is hardcore pricing and a sharp drop in rates already by year end and all that. You can see the dot plot that's been in the headlines lately. And I don't blame them. How can the guy have a shred of credibility at this point, really? And I've always said, and so I'm going to digress. I'm amazed when I turn on the TV and I watch these guys come on and all they do all day long debate on CNBC what the Fed's going to do and what it's going to mean to the market. And I've always said this: the Fed has no idea what they're going to do. They're reactive, not proactive, and whatever they say today, they're going to change. It's easy to figure out what the Fed's going to do before they tell you, announce they made a pivot or whatever, because you can, just watch economic indicators, watch inflation. And this is one where I'm going. If I'm right and we start doing this, you're going to see that the dot plot, or the way the market's forecasting rates, you're going to see that change, and we're not going to see expectations that the Fed's going to cut as much as the market's already expecting. And if I'm wrong and we drop here, well, guess what? That opens a door that if we are heading into a recession, the Fed can cut rates. It's going to give them room to cut. So this is what's going to hand tie the Fed. And I've talked about it ad nauseum lately. It's that vicious cycle. Or negative feedback loop. So either way, I like it. RR is good. Somebody asked about oil the other day. This target right here, if you look at the pop-up box, back on June 3rd, 2022, I had laid out this was a maximum swing target. I had 58.60 in the uptrend line. That was at the highs. June 2nd is right there. Let me see. I made that on June 3rd. I'm going to put the crosshairs on June 3rd. Right there. What was that? 3 days before the peak in oil? That's the target I called for. That target just got hit. I called it at the time, in all disclosure, it was the combination, because I didn't know when we'd get there. I had this uptrend line coming in, and I thought the correction might happen a little sharper and come in right there. Either way, there are two levels, and what we did is we did hit the uptrend line, I pointed out at the time, and we bounced on it several times. Then we took it out, but now we went down to hit that 58.60. Okay, what does that mean? Am I patting myself on the back? No, but that means that is a very, very good support level that I expected to cap end the correction in crude oil, and it's been hit, and now we're rallying off it. I mentioned just recently that bullish crude, showed you a chart. I also mentioned it as a good hedge to index shorts. Why? Because two reasons: technicals, but from a fundamental perspective, market's going to be right or wrong. Stocks are rallying, especially big tech, which are cyclical growth. That's the market saying we don't think there's going to be a recession, or if it is, it's already priced in and it's over in the market. The stocks are fairly valued. Well, okay, this whole stock market continuing to rally thing, if you think stocks are going to continue to go up, especially growth stocks, tech stocks, then you have to assume economic growth is going to increase. And if that happens, there's going to be a higher demand for oil. More people taking vacation, more business travelers jumping on planes, more construction, things that are energy intensive, and so crude oil should go up. So again, to me, it's a good hedge because if again, if you're running a swing or trend short portfolio, giving them a little room, and everything continues to firm up in the stock market, then you would think by that fundamental reason crude should rally. And technically, there it is. You have big positive divergence at that low recently, and you have a downtrend line there, potential downtrend line, which could trigger a much bigger. This is what I think in that to the comment. The person who's long crude right now, you really got to pop this level, and then that would be open the door for another run to crude. All the way back up here to 78.41, maybe even visit those highs. Of course, if the stock market scenario that I have, that pretty hard down, another leg down, the bear market plays out, crude's probably not going to go too much. And then at that point, you can remove the hedge because you're going to have demand destruction in crude. So, in other words, if the stock market continues to rally, you have demand creation or inflation, whatever you want to call it, whatever the opposite of demand destruction is. All right, so that's it. Just wanted to hit on that. And again, this is also just about all the commodity indexes and the commodity tracking ETFs. Crude oil is a big component. Energy, crude and natural gas, but crude to a larger extent. Natural gas, this thing's going to rock sooner than later. We're at big positive divergence. This is UNG. I just don't have my other charting program. I don't have it queued up, the charts for it. That's about, you can see, as low as you get. I do have on natural gas. Remember, UNG is an ETN. It doesn't do a perfect job. There's going to be decay. It's not leverage, not that type of decay from the leverage, but the fact that UNG is rolling, they have expenses to continue to roll these future contracts over time. It's not going to mirror. I'll do an up. I've covered the natural gas futures charts recently, and we're not at all the lows for the past decade, but very darn close. And so. And watch it. And again, it's going to, the downside, there may be more downside, maybe not. It's probably minimal. And things like natural gas, commodities, the reason I like them is they don't go bankrupt. They don't need bailouts by the federal government. They're going to be there. There's going to be demand. And you ask yourself one question. Are there more people on this earth today than 10 years ago? Let's just look at DJP and I'll get off my commodity rant. So we go back here. From a fundamental perspective, this is where commodities were. Again, this is one of the most diversified and balanced commodity ETNs. So we're up here, and I'm going to measure it in percentage terms. This ETF, even today, where we're at now, we're 58% below where we peaked in 2008, and that was after a bear market of 80%. So ask yourself, in 2023, right now, are there more or less people in the world, more mouths to feed, more people, eating corn, and demand houses having to be built, pulling in for copper and lumber and all those things. And also ask yourself, is there more or less arable land today than there was in 2008? Now we're running out of that, so it only stands to reason to commodities. Over time, this is a place where, in my opinion, they're going to go back up. And is it that unreasonable to think that commodity prices could get back to where they were in 2007, 2008, when we were in a non-inflationary and one of the most benign inflationary environments for decades, and now we're in the most hyperinflationary environment since the late 60s, early 70s? Mid 70s. It's okay. There's a fundamental case for you right there. So, anywho, all right, let's get away from that and look at one more thing I wanted to show you, and that's going to be bonds. So these are government bonds. If you've missed this, I've covered this many times for years now. Been highlighting this, the trend that was the end of high interest rates, high inflation, runaway inflation that went throughout the 70s into right around the peaked right around late 1980, early 1981, right? And interest rates, I remember as a rookie broker back in the early 90s at Merrill Lynch having clients come in with literally 15-year treasury bonds. I'm sorry, 15% treasury bonds with 15% coupons. CDs were, and that was those coming off the 10-year, that had 10, 15-year that were coming due. And those days are gone. Then we ended a secular bull market in interest rates, began a secular bear market. That is a larger trend. Within there you have cyclical bull and bear markets. And then you had these unnatural spikes that took you down through the channel, and those are our bouts of quantitative easing and shenanigans by the Fed to artificially bring rates that were already low down to again ultimately in virtually zero levels. And remember, the Fed, this isn't the Fed funds rate. They took them down. They did zero interest rate policy first back here in '08, right, with the first round of quantitative easing. That's not shown. This is a 10-year treasury bond. The Fed does not directly control 10-year, 30-year rates. They don't even control the 5-year rate. They control the overnight lending rates that banks borrow money. So that's what the federal funds rate is. But then what happened is longer term rates, the more they did that, the more it was apparent we're going to be heading into recession. Longer term rates started to fall. And then they did, they can influence the bond market with that's what quantitative easing is all about, try to bring down long-term rates as well. You buy enough treasuries, that's print enough money, you can do that. But then that broke out. So there it is. That's what I've maintained. There's the breakout of the primary downtrend line, and by every metric, meaning taking out all the previous highs. This is early stage bull market action. So whether we correct or not. I think we're looking at a many years of higher or rising rates, and again there'll be some big old bulls and bears to trade within there. But let me just show you. Let me zero into where we're at right now. So this is TNX. I can spend time, and it's not. You're going to see almost the same thing with the 30-year. The 10-year bond is probably the single most important one to track. 30-year mortgages tend to track the 10-year Treasury bond better than the 30-year Treasury bond. That's what most experts will use, is the 10-year. And here's your trend line right there. There's COVID right there. See the bottom, that spike? Look at all these reactions. That's 1, 2, 3, 4, and now 5. We are at support. Remember, this is the yield. These are what the bonds are paying. The bond prices move inverse. What this tells me is we are at support at a key trend line, and rates are likely to go up from here. They could break. When you're at a trend line, that's part of technical analysis, part of what I do. I have to decide when something pulls back to support, is it likely to bounce, in which case you want to go long. If it, in this case, remember the Treasury bond, you don't go long, you don't buy the yields, you buy the bonds, so you short the bonds, which is what I think will happen. Or is it going to break? Well, if I go down to the 60-minute chart, here's what I see right here, and this is what I wanted to get to you guys. All right, so okay, the markets. When did the markets bottom, guys? Yes, right, October, mid-October 15. And what happened since then? So rates were going up, stocks were selling. That's when stock market bottomed right there. A lot of people are declaring the end of the bear market at that point, and that's because the markets didn't like rising rates. That was inflationary, right? Since then, rates abated, and we've had a couple corrections. You can see here, you had a positive divergence, and yields rallied. Interest rates went up. Then you had a correction again, another divergent low, and an even bigger drop. And here we are. We're coming off. Bottom line, look at these divergent highs. Divergent high, this happened, all this. Divergent low, 1, 2, there they are marked right here. And now 3. This tells me rates are likely going higher. Market's not going to like that. Market rallied in the last couple weeks leading up to the Fed meeting because interest rates were dropping. And you're at support. You can see it's nice support. So this to me is a case that rates are probably going to increase here, and the market's not going to like it. And it aligns with my stocks down theory. Let's look at a few other things. There's the 5-year short-term yields. Same thing. This is simple stuff. Divergent low, rally. Oops. No, or divergent high, correction. Divergent low, rally. Divergent low, rally. Divergent high, correction. Divergent low, rally. Okay, so that's all. It's all right there. Looks like yields up to me, bonds down. And let's look at the bonds themselves. This is TLT, the 30-year bond. I'm just going to point out a few things. Here's the 10-year bond. I want you to look at something. Look at treasuries. Let me turn off all the lines for a second. You can see treasuries, bonds have been moving up. That's because rates have been dropping since the market's bottom. Remember, higher. This was TLT falling. This means interest rates were going higher on the 30-year bond, and that's when the stock market bottomed right there, mid-October. Since then, rates have been moving down. But if rates start to go up, then bonds are going to fall. Stock market's not going to like that. And that's also going to cause a lot of additional pain for those the pension funds, which I still think private equity and especially pension funds like CalPERS are the next big shoe to drop in this financial system. Crypto was first, banks were second. I, among some others, were calling for for the last year and a half for things to start breaking in the financial system. Those calls proved to be true. And I think we're seeing just still the early stage of the cracks. The pension system, public pension system, is huge, and they've already been underfunded for years, using, in my opinion, almost overly optimistic return projections, especially taking in the bigger picture. Go back, and I'm not going to pull it up again, but look at that TYX chart, TNX. You were in a falling secular bear market of interest rates, and I've showed you before how the stock market was in a secular long-term bull market. It's very, very simple. It's an immutable rule in the stock market, in the financial markets. Stock market likes falling interest rates and the economy because the cost of capital is cheaper. and it's also the alternatives, and it does poorly in rising rate environments. So all right, this is why I spent all this time. This stuff, it's not that complicated. You just have to look at all of these other things. And look, again, I'll be right or wrong on this stuff. And sometimes there's a disconnect. Sometimes you can see bonds going down and the stock market's still rallying. But lately, especially with everything, interest rates are much, much more in hyper focus right now than they were for any time in the past several decades, because we were in a non-inflationary environment back then. It didn't matter if rates went up a little bit because there wasn't much of an impact. You were in a low, very low controlled inflationary environment. All right, so that's that. But now what I wanted to show you as well, there's IEF. So you can see the government bonds making these higher lows. But I pointed out there's some things to watch. LQD lately, this is investment grade corporate bonds. They broke down yesterday. I was going to do this video yesterday at the end of the day, and I started kind of putting everything together, and I figured, you know what, it was late. I was going to get it out to you today. So we just broke down. So that's a sell signal in corporate bonds, meaning bond prices are likely to fall, rates are going higher. Junk bonds have been, you can see, outperforming that lift in treasuries, and that's one thing people look at. Smart money, institutional investors. Treasuries are well off the lows, and junk bonds are not moving up as much. They're much closer to their lows, and that shows you credit spreads are widening. That is a precursor to economic weakness, a contraction or an outright recession. So continue to watch junk bonds, JNK, HYG, and the other one that I'm watching, and I pointed out, the muni sector. Well, there's FLN fallen. Municipal bonds. These are muni bonds. They just broke down right here. MUB is probably the most diversified national municipal bond ETF. Bonds from all different states. But where I've been pointing out and have my crosshairs, a lot of these big blue states, particularly California. As I talk about the implosion, the impending problems with the big pension funds, CalPERS being the largest in the country, that the taxpayers are on the hook for shortfalls there. It's not the federal taxpayers, state municipal taxpayers, the state of California have to make up legally any shortfalls. And they've got some massive ones. And that's only going to get worse if they can't meet their projected returns. Which I don't see how they can. And then that whole private equity shooter drop thing with the mark-to-market. If you listen to the talking heads on TV lately or read up on this, one of the biggest problems was in 2008 they got away from mark-to-market. They allow banks. They passed regulation, and so Silicon Valley Bank was hiding huge losses. Mark to market means those bonds that were marked to maturity should have been marked to be sold or marked to market. So they were sitting on huge losses that, if they held them for 30 years, those bonds would mature and pay face value. And so that's, the criticism we have now is we've got to get to market. Now, that's where I think that these hedge funds, private equity funds, and by the way, the hedge funds have shifted in recent years a large amount of their portfolio into private equity, away from publicly traded securities. So publicly traded securities are the stocks you and I know, Apple and GE and all the likes. And they are, their books are wide open. Their accounting rules, and it's a lot harder. They can, as Silicon Valley shows you, if you don't, if you knew where to look, you could have seen that before. Most weren't looking for that. I'm sure there were a few adept short sellers that knew that and profited from it. But it's a lot harder now on private equity. That's why a lot of companies go private after being publicly traded companies. It's easier to do what you want to do. The scrutiny isn't as hard. So, and it's times like this. It was, I think, Warren Buffett that said, when the tide goes out, you see who is swimming naked. So where am I going? Okay, this is California. Here's the lows back in October right there. California is just spitting distance off those lows. This is one, and most will look like this. This is just the PIMCO, California Municipal Income Fund 2. That tells me there's a problem with those bonds. They are lagging. They are really lagging behind national muni bonds, which are quite a bit more comfortably off their October lows. There it is. So you can see that. In other words, let me just measure it. MUB right now is trading up 5.63, and PZC, which is just the proxy that I'm using here, is only at, off those October lows right there, trading about 3.5%. That's a pretty big disparity. And you can see again, they started a rally like everything else, but this is where I think the smart money's sniffing out problems to come there. So anyway, so that's in California breaks, has some problems. You know, I don't know where it is now. Years ago, I remember 5, 6, 7, 8, 10 years ago, I heard it was comparable to the seventh large economy in the world. You know, bigger than most countries out there. Just the state of California's economy. So they're big. I don't have to tell you that. And you know, something's rotten in the state of, well, maybe not Denmark, but something's rotten in the state of California. Just keep an eye on it. You know, if it's not, then this is the ARBs will pick up on that. If everything's hunky dory, then that differential between MUB, the National Municipal Bond ETF, and California, that the gap should close there. I also looked at a couple others. MIY is Michigan. Same thing. It's lagging the national bonds. Looked for Illinois, but they don't have Illinois bonds. I'm assuming it's been a long time since I sold muni bonds, but they must not be taxed at the state level. So you don't have, I couldn't find any Michigan or Illinois bond funds that are specific to that. Just like Florida. I live in Florida. Florida, like all states and municipalities, they sell municipal bonds, but there's no Florida Muni Bond Fund because we don't tax, we don't have a state income tax. And so then, you know, Florida residents can buy from any state, and they're going to buy it, behooves them to buy the highest yielding ones. Okay, video did go a little bit long, but I wanted to get them all out there, everything I just did, because they're all interrelated in my opinion. Commodities, bonds, and the stock market. And for the simple reason, make no mistake about it, this market doesn't even care. We've never, since I can recall, even going back to 2007, 2008, had so many hardcore recession indicators flashing that all but guaranteed a recession. The market's shrugging it off. What I'm trying to get at right now, the market isn't all that matters to the market is what the Fed is going to do. It wants its juice back. This is a heroin addict that has been on the juice for 15 years. If you go out and your friend or whatever, you try heroin right now, you're not going to be addicted, but you do heroin for 15 years, it'll kill you to get off it. You know, that's why you have methadone quit. You have to taper a heroin addict off, and this market wants the juice so bad, and that's all that's going to rally. So what I'm getting at here is watch interest rates. If long-term rates start going up, or interest rates as a whole, it's not going to be good. It's going to put the brakes on the stock market rally, and that's my current projection. Looks to me like rates are going up, and hence stocks should go down. So we'll see. And I gave you levels to watch if I'm wrong. One of them is going to be that recent high, last week's FOMC, that top of that range. And as I wrap up here, we're starting to crack. We've just now officially taken out last the Wednesday, the Fed FOMC meeting. We took out that candlestick low right now, so that gives me a check mark. But like I said, this is a 60-minute candle. I'm going to wrap the video up here. It's either going to close below or back on or above. But like I said, I'm sticking with my swing shorts for now, overweighting the tech sector. This has been Randy Finney with Right Side of the Chart. Have a great day.